Hello, everyone. This is Joseph Trevisani from Worldwide Markets. Good afternoon, good evening, and good morning, depending on where you are in the world. I know that Adinda, who is hosting this for FX Street, is in Indonesia, and it's late evening there. It's 10 o'clock at night. Anyway, today's topic is, I thank you all for coming. As always, I take it as a great compliment that people will take time out of their day to listen to me. If you have any comments or questions or anything else that you would like to add to the webinar, either to myself or to any of the other participants, please do so. Just type it into the chat and I will discuss it, or other people can answer your questions. Today's topic is a fundamental topic. I do these webinars once a week for FX Street. And I alternate either currency or technical topics. We just started 2 weeks ago with fundamental topics. Today's topic I titled The Commodity Combine. You know, commodities used to be, when I started in the business a number of years ago, in the early 90s, a kind of an esoteric topic. And if you look at the chart that we have up right now, you'll see perhaps why. Now this is a chart of, and this is going to chart I'm going to close. So anyway, this is where we're going to approach it today. We're going to look at some of the changes in the commodity market. What has driven them? Whether they are purely the reflection of a change in a fundamental aspect relating to the global economy or the local economies, depending on who's using the most of any particular commodity, or whether there has been a fundamental change in the conception, and conception might not be the right word, in the use of commodities for the world's trading markets, for the world's traders, for the world's hedge funds, for all of us. Just as an example to start with, then I will move on. Let me backtrack a little. Then I will move on to some of the specific changes that have taken place in the commodity markets. My thesis is not an original one for myself, but it is one which I think has a great deal of relevance towards the uses that commodities are taken to by particularly traders who might in the past have used commodities as fundamental indicators, which in many respects I no longer think that they are. So my case is that they have moved, commodities have become, as with, and I thought this is a prima facie case, you can just take a look at it and I'll present the evidence, have become highly specularized. I don't know if there is such a word. I think there isn't. I think I just made it up. And that has changed their fundamental nature as far as their trading and also as far as their economic indicators, their uses of economic indicators. For me, this chart tells the whole story, but we will break it down. This is not the first chart we're going to use. We're going to end on this chart. This is a chart of gold. Now, I'm not going to deal with gold today. I would like to. Gold is certainly a commodity, but gold is so much more that I think gold is best handled as a topic on its own. I just want to make sure we have the chat links up here properly. And this one as well. Okay, I believe we have both chat links up, so should be working. Okay, good. Sorry, I just had to check. Gold deserves a session of its own, maybe in 2 weeks, I'm not sure, but I think that we will cover that by itself. But anyway, this chart here is gold, which you can't really see very well, unfortunately. The Fed funds rate in yellow, DXY. Now, I should have used the trade-weighted dollar, perhaps, but I chose the regular one because we're more used to it. And Bloomberg Commodities Index. You can take the commodity index as a representation for oil. So you can see that something happened around 2002. If you look at the indexes, everything gets much strange. Oh, oil. I'm sorry, oil is here. Gold is the candle chart. It's right there. You can see very easily that something happened. And what it is that happened is one of the things we're going to be exploring today as to why this took place and perhaps how it took place and some evidence that it did. So let's start with, I'm going to start with the oil market. Okay. This is WTI from 1980. Okay, now in any trading market, there is a natural tension between fundamentals and technicals. It's natural to every market. We all talk about it. Fundamental are supposed to be the things that give us long-term trends, and technicals to simplify everything, of course. The technicals give us our entry and exit points, and they also give us points of acceleration, which perhaps for today's trading, with its heavy emphasis on high-frequency trading and hedge funds, which comprise an unknown but very large percentage of the market. And what's more, as far as their percentage goes, I will probably do gold in 2 weeks. And I thank you for your interest, and I love gold. I love gold because I wrote a piece maybe a decade ago already, that gold has 3 aspects. People are afraid of inflation, the people who are just traders, and then there are what I call the Armageddonists, those who are building bunkers and afraid, I am speaking metaphorically here, and afraid the world is going to end and that gold is going to be a hedge against the end of the world. I love that last one, because if the world does end and you've got a basement full of gold, I have no clue as to what good it's going to do you, but it may make you feel better. Anyway, so I'll probably do it in 2 weeks, but I have to decide. So this is oil. Oil. I take oil. I thought of covering. There's only so much you can cover in an hour webinar. And if you do too much, you end up not sticking to your theme, which I have a tendency to do, and I want to keep this one pretty focused. Oil is the basic industrial commodity. If there is any commodity, oil and the availability of cheap energy is the definition of industrial society, certainly 20th century industrial society. You can argue that coal was the definition of 19th century industrial society. But the key to both of them, the most important point, is that cheap available energy changes everything. Industry, life, home life, civilization. So for an industrial, highly industrial, some say post-industrial, but post-industrial is, in my mind, a piece of nonsense, because there is no post-industrial country or culture or civilization or economy on the planet. You may get your industrial products from somewhere else rather than down home, but there's no such thing, and nor can there be such a thing as post-industrial economy, except in science fiction. Actually, I was talking to one of the people from FX Street before the webinar about the Wachowski brothers movies, the Matrix movies. And I was commenting how Google is probably the model for that. However, we'll leave that alone. This is not a disquisition on science fiction or on the future. Oil, the primary industrial commodity. Look at the period up until 2000. Very little variation in price. Was the world not growing in those days? Now, China hadn't entered the picture. That's true. Chinese post-industrial development took off, started taking off around 1990 or so. Nonetheless, excuse me for a second. Sorry, remnants of a cold here. There was tremendous amount of industrialization and development in the pre-2000 period. Oil varied from about $40 to about $15. That's $25. That's not a great deal. But that was this, and it went on for 20 years. Something changed. Changed oil's largely industrially derived trading values. As a matter of fact, what do we have here? In the early 80s. What do we have there? Well, a little mid 80s. We had a recession in the United States, big recession in the United States. We have the 1990s, another recession in the United States. So the variation in the price of oil was very closely tied to industrial business cycles, if you will. And here we are staring at about 2000. And even through 2004, not too much has happened. We get up to 40. And then suddenly, about 2005, things go, to use a technical term, bananas. What happened in 2000? I know, actually, I'm going to give you the answer. Of course, I know what happened in 2000. But to change this aspect of oil. Now, let's look at another chart and see if we have now we're looking at BCOM, okay? Let's take another, let's see how far back I go on this DXY. Okay, now here, let's take a look at this. This is copper, another primary industrial metal, It's easier to track copper than it is for iron ore, so I decided to use the copper as a representative. And we have a similar thing here. 2004, 2005, about the same dates. Suddenly we get all of this interest in trading. Oh, you might not have seen that copper one. Hold on. I just realized it might not have gone up. Here. Okay, copper. Here we go. Here we go. Okay, same thing. Copper, 2004 suddenly takes off. Why? So let's tell the story from oil's point of view, and then we will look at some of the specifics involved in some of the other items. So let's just take one. Let's just look at the. Come on, computer. Hang on a sec. An imperfect technology, this computer stuff. Sorry, where'd my mouse go? Oh, come on, mouse, don't die. I think my mouse just died, folks, which means I need to get a new one. Come on. All right, folks, I'm sorry I have to delay for a second. My mouse just died, and without a mouse, you can't do very much on our computer these days. Let's see if I can put up something for you. There are some controls on here. But none for the window. I'm sorry, folks. I have to sign off for a minute. I have to get this mouse fixed. It just died. Sorry. Okay, we're back. Sorry about that. So instead of a wireless mouse, I now have a wired mouse, and guess what? It works. Okay, here we go. Sorry about that, folks. My apologies. Okay, so now we're going, where was I? Okay, we're going back to oil and its change in the early part of this this century from what it had been to what it was before. Okay, here is the original oil chart. Okay, so we noticed that something happened around 2000. What could it be? Let's take a look, okay? And I'll tell you the story, because there is a story, and it's interesting. It's fairly well known. It got reasonable coverage, but nobody really references it much anymore. I think it's fascinating, but anyway, I think odd things are fascinating. Okay, here we go. This is total open interest on the NYMEX. Now, I don't know how many of you know some of the details, but a lot of the story I'm going to tell is a bit technical as far as particular markets here, having to do with with changes. And of course, Goldman features prominently in it, as Goldman seems to feature prominently in everything. Okay. Oil is traded on futures exchanges, I'm sure, as you all know. NYMEX in New York, ICE, and I think LIFI also in London. Those are the primary places for trading, two of them, London and New York. London and New York being the financial centers of the globe. Two imperial centers, but let's not discuss that one. The NYMEX in New York and ICE in London. Now, the NYMEX is the older exchange. And up until I think about 2000, it was the primary trading venue for futures on oil, commodities, things like that. And also with the MERC, the Chicago, and the Board of Trade in Chicago. As an industrial commodity in a futures market, futures markets are designed, of course, and originally, there are futures markets in agriculture originally to help farmers hedge their crop exposure. And I don't mean out on the fields. Designed for delivery. If you buy a futures contract on wheat, it's assuming you want delivery of the wheat. If you sell one, you assumingly have wheat to sell. And that's why you go into a futures contract, to lock down the price. So originally, futures commodity exchanges were very closely tied to the real world, if you will, the real economy. And that was true of oil as well, although not quite as much. There were restrictions on the NYMEX as to who could have open positions in oil. And there had to be, because if you can't gain access to the exchange, you can't trade oil. You can't trade oil futures. And that limited the types of, or the volume of trading in futures, in particular commodities. Now, think about the foreign exchange market, where there's no limit. How much of foreign exchange trading, as an analogy to oil and the commodities markets, is real economy based? The answer is almost none. 90% plus or more of the daily turnover in foreign exchange is speculative position taking. Now, there have always been locals and other speculative traders on the exchanges, but they're rather rigorously controlled by the exchanges. And in oil, they were controlled by various rules on the NYMEX. Around 1980, I don't know how far back before that it went, a number of major players, corporate types, such as Goldman, there are others involved as well, some American banks, some European banks. I think Chase was involved at the time, or maybe Morgan, I'm not sure. I haven't read the article in some time, had, I don't know who's responsible for it, a vision, if you will. That remember, this is the beginning of the internet. Our first company, FX Solution, was formed in 2001. That's where we're going to. And there were people who saw the potential for this. That's my reference, of course, to the Matrix movies, who saw the potential of this technology. Not just, I used to call it a fancy phone you buy on the web rather than in a store or through a catalog. It's kind of sad to look at, or at least interesting to look at, that Sears, what used to be known as Sears Roebuck and Company, the United States, the first nationwide mail order mass market company from the early part, if I remember, the late part of the 19th century is when they got started, are probably going to go out of business. They've been in trouble and losing sales, store sales for years. And what killed them, of course, the internet did. And that's true of many brick and mortar retailers. But they did something which no one had ever done before. They shipped goods through the U.S. mail. If you're living on the frontier, well, it wasn't much of a frontier by 1890, but if you're living in a small town in the Midwest with only a daily or a weekly train, however often it came, the only goods you had access to were those carried by the local stores until Sears Roebuck came along with their catalog. I remember the catalogs from when I was a kid. It looked like a telephone book, although I imagine, it's funny, there's still, about a year ago, I saw the last telephone book, an actual telephone book, delivered to our apartment in Manhattan. And my girls were 7. They go, "What is this? Phone numbers?" They've never known anything but cell phones. Anyway, so oil. At the dawn of the internet, there are some businesses and changes in existing businesses that the internet almost mandated. And if you were there to catch that wave, you did well. FX Solutions, our first company, did. There was no way you could have had a retail foreign exchange business without the internet, period. It's a business created by the internet. eBay, created by the internet. Amazon to a great degree, but less so, created by the internet. What else? The ability to shift money around through the world's markets became infinitely easier with the internet. Now, hedge funds sort of created at this time, and there were reasons for that, which we're going to talk to in a second. So the idea of these corporate types was to set up a new commodities exchange, ICE, Intercontinental Exchange, it was called, in London, with no essential limits on speculative participation. So instead of having the NYMEX in New York, where in order to trade gold, you had to have some sort of link to the gold, trade oil, excuse me, you had to have some sort of link to the oil market, production, use, mid-market, reseller, something. You now have an unlimited ability to participate in speculating on commodities. This is a chart of two things. Yellow is the price of oil. Now remember the original oil chart, right? I'm not going to put it up, where there's that incredible, I'm sure most of us remember that. Is anyone here young enough not to remember the oil spike in 2007? I wonder, perhaps. But I'm sure most of us do, when oil got nearly to $150, right before the financial collapse, which is, of course, on this chart, is here, right here, in 2008. Remembering the variation in oil, the volatility in oil before that, this doesn't make any fundamental sense. It only makes sense from a speculative, hot money, hot market point of view. And that is exactly what we have here. The white line. It's hard to get good historical information on this. I wanted one going back to, say, 1990, but I didn't find a good report. Now, all the charts here are Bloomberg, by the way. Look at the ramp up in 2006 to 2008 in open interest, mostly long, on the NYMEX. What had happened? Under pressure from the ICE exchange in London, which had basically lifted the rules on participation in the oil market, pursuant to losing all their business, the NYMEX did a very similar thing. So suddenly, almost anyone could participate. Well, who participated? Hedge funds, big players, not you and I. But we could have, although were we offering oil then? It would have been hard. So originally, in 2004 and 2005 and 2006, you could have participated in the oil market if you wanted to. Probably not directly through the exchange, but certainly through a secondary market makers such as FX Solutions was in those days, or Worldwide Markets is now. The open interest exploded in the oil market. And guess what it did? It drove the oil price up. Now, why is that the case? Well, that's simply a function of trading markets psychology. If you have a roaring bull market in oil and you're going to participate in the market, what are you going to do? Sell? Well, you can, but you'll probably go broke. So most people, of course, who are participating in the market, and most of these, I think, were probably professionals, or at least they made a living doing it, or tried to make a living doing it. Whether they're professional or not, it's another story. Went long oil, and that is what drove the oil market to 150. And look at the spectacular collapse. Now, we all know lots of things were collapsing in those days. But what's interesting is, now this doesn't give you the composition of the open interest, but look at what's happened. Even after that spectacular price collapse, all the longs got out. The volume, the open interest stayed much higher by several factors over what it had been previously. So there is a fundamental change here in the nature of the oil market. And I would make the case that this is true of most accessible commodities. It's true of copper, it's probably true of gold, although gold has always been, excuse me for a second. Although gold has always been a favorite of retail traders. So this fundamental change in the nature of the oil markets. Now, what might have driven this change? Remember, the companies that formulated this idea, that came up with this idea and formulated the ICE exchange, are profit-seeking entities. Now, what could have inspired Goldman, just as an example, I'm not picking on Goldman, to think about this change? Let's see if this is the right chart. Yes, here we go. I don't say this is the only reason, but it is certainly part of it. This is the oil, the WTI, West Texas Intermediate generic, these are all the generics, versus Fed funds. So we know that around 2000, they set up, various corporate types set up the ICE exchange in London to compete in a rather I won't say unregulated, but uncontrolled as far as volume goes and who can participate, with NYMEX in New York. NYMEX is forced to go the same route and lift many of the controls, if not most of the controls, on who can participate in the oil market. So what is going on in the period from the early 80s? Well, we have a worldwide, and this is just the Fed, but it works as a description for what's going on in the world as well. We have a long-term decline in interest rates. And in fact, in 2000, right, having to do first with the collapse of the dot-com bubble in the United States, and other places as well, but primarily the United States, and then the 9/11 attacks in 2001, interest rates enter into a long period of very low rates, as low as they really have ever been in the United States for that prolonged period of time. When you have low interest rates like that, it makes earning steady income much more difficult. You start looking as a hedge fund manager, an insurance company, although insurance companies are restricted as what they can do. You start looking for places to earn returns. And one of the places, the only place really, that you can earn potentially outsized returns are in the trading markets. And so you have the combination of three things. You have the idea that we should let people there should be more participation, if you will, in the markets. We have the internet, which facilitates it. And we have the Fed driving rates to low levels for prolonged periods of time, which damage other ways of finding return. All three of them come together, if you will, in the ICE exchange and the explosion in trading interest in oil, but in commodities in general. Let's take a look at another chart here. This spike, and I cannot emphasize this highly enough, this spike in oil prices has zero to do with fundamentals. And the subsequent values in oil from 2010, if we look at the global economy and global demand, what do we find? There's no excessive, yes, demand is growing, but what's growing more and what the markets are paying far more attention to is sort of a transfer of the way you trade foreign exchange. If you have a economy, say the United States, just take the United States versus Europe, just take that as an example. US is growing more strongly over a period of time, then the dollar will get stronger, but it will get far stronger than a simple differential factor between the two economies, because what you have is a acceptable trend to the majority of traders in a speculative market. So currencies overshoot. Everybody goes long until the narrative changes. That had never been before this really the aspect of commodities. I know, yes, you're going to say people know the shouting in the old Chicago pits. That's all true. But the volumes involved were such that, and the restrictions involved were such that they never drove commodity markets to excess. This chart is a chart of excess. Speculative excess. And now you have a similar type of trading ruling commodity markets. And it's now the future. The future's here. It's not going to go away. So there's very little in worldwide demand. Through 2010 through 2014, where oil is suddenly scarce. What is going on in this period? Well, everyone is anticipating You read the narratives all the time. One thing about the business press is if you read it once, you can guarantee you just do a little more searching on the web and you'll read it 40 other times. Everybody says the same thing. What's going on in this period right here is that trading is taking over the markets. Nothing wrong with that. We live in a world where trading is, but it's a new aspect to oil and to commodities. And the thing about commodities are, it has very profound effects globally. If the dollar gets stronger versus the euro, or just gets stronger, its effects are by several factors because it doesn't move that much. Limited economically, United States and around the world. When oil goes from 20 and then to 60, that's a 300% increase. When it goes up to 150 and then comes back down, that determines the price paid in the real world. Oil is the basic industrial commodity. So it's not quite the same in its effect as a 10 or 20% rise. And a 10% rise in the dollar over time is a big rise. It's a big gain. Those are the orders of magnitudes of change in pricing that are typical of the foreign exchange market. The commodities markets now put that to shame. Okay, what else does it do? Another effect of commodity pricing is that it distorts investment. This is, of course, combined with low interest rates, where you're looking for something to do, and Beijing is throwing free money and free loans to everybody to grow the economy or keep people in jobs. But you have this money looking for someplace to go, looking for something to do. Well, at $80 a barrel, and these, of course, were the years of peak oil. Complete nonsense as far as predictive ability. The one thing we should all be sure of is that we have almost no ability to predict the price of oil 5 years down the line. None. There was the consumer sentiment surveys out last week. And as part of that, they asked, their survey people, normal respondents, what they think the inflation rate is going to be in 5 years, which is a hysterical question. And of course, the answer always reflects the current expectation or maybe the 3-month expectation. Nobody has a clue as to where it's going to be. But the point is, they're asking consumers, because supposedly if consumers expect more inflation in the future, they're going to buy more now. This is not true. This is like the wealth effect. It's also largely not true as far as its effect on the real economy. But the Fed can't ever, our vaunted central bank, can't ever get its economic, GDP, or inflation projections remotely correct. And so they're going out and serving everyday customers, you and me in the street, asking what we think in 5 years. It has like no reality to it whatsoever. Anyway, so another aspect of this is that it creates all sorts of incentives for investment. As the cliche from the markets go, and it's, I don't know who said this, the cure for high prices, I think it was specifically said about oil, the cure for high oil prices is high oil prices. Sounds cryptic, sounds like a cone. It's not. It just means that high oil prices draw in investment, investment produces product, product brings down the price. That's exactly what we've seen. So these are real effects, because it's my contention that, take a counterfactual, had ICE and the NYMEX not changed their access rules, you would not have seen this spike. Yes, oil would have gone up because there's rising demand. More and more people are using oil. Cheap energy is the basic ingredient of industrial society, of middle class society, of wealth creation. It's the basic ingredient. So as long as vast swaths of population, China, for example, India, for another, many places around the world, are moving from poor people to not so poor, or middle class, or wealthy, or whatever you'd like, it's based on the availability of cheap energy. Okay, so we have seen the change in oil, and let's see if this translates over to other commodity markets, okay? And here we go. Okay, this is oil in green. The Bloomberg Commodities Index in white, and the Fed funds in purple. And we can see that this is not just, now, oil is, actually I have the definition here. It's not very helpful, but I read it. Bloomberg Commodities Index. And of course, you're going to say, well, it's a weighted index, so you're going to have some reflection of the actual oil price in the commodities index. And of course, that's true. But I can tell you what it says here. The index rebalances annually, weighted 2/3 by trading volume and 1/3 by world production. And weight caps reply the commodity sector. Okay, so there is an aspect, of course, that if oil speculation rises and the volume rises, you're going to see a concomitant change in Bloomberg Commodities Index. True, but that's not the only factor here, because it's weighted. So the same type of price escalation, not specifically tied to, or even at one remove as we trade, global economic growth, we saw in commodities of all types. Again, we're back to the idea that there has been a fundamental change in the way commodities are traded and priced. Another topic, of course, which we're not going to talk about, is what does all this volatility do to various types of economic endeavors around the world? We're not going to approach that one because I don't actually know the answer to it. And I think since we're in the very beginning of discovering what may or may not be, I don't think it's going to have all that much difference, but nonetheless, because everybody has much better access to information. Okay, so let's take another aspect of this change in commodities and see if we can tie it to something else. Now, commodities and oil is based in dollar pricing, right? Commodities largely around the world are priced in dollars. So maybe oil went up because the dollar went down. That would be the way it works, of course. As the dollar gets more expensive, I'm using DXY here. So yellow is DXY, white is oil. The explanation for all of these things is multifarious. There isn't one particular explanation. And so we can't only focus on one thing. We have to try and deal with all things. Oil. Here, Adinda, I'm assuming that we're running till 1 o'clock, 12 o'clock here in New York, so that's under 15 minutes. Just want to be sure about that. If it's not true, just send me a text. So if this were tied to, if the escalation of the price of oil was tied to a profound collapse in the dollar, okay, we have a portion there. And the dollar from 2000 to 2009, the dollar did decline, DXY. Right? This is DXY. That went up a little bit. And so, yes, that is a factor. But look back here. DXY back in the 80s. DXY took a huge fall. This is partially due to the change in the Japanese yen, but that's another story entirely. Anyway, DXY comes down. What do oil prices do? Look at this period here. They don't respond anything like this. Look at another, a rise here from 1995 to about 2002. DXY went from maybe 75 to 120, a little bit higher than 120. Oil does not respond. So the change in oil pricing after 2004, if you will, or 2002, is not something that can be tied to variation in the dollar. Just an examination of the exponential differences in the variation in the two will tell you that. Okay, so we can dispose of that. Now, there is an effect, of course, and thanks, Adinda. And often it's a trigger for a change in a world, in a trading view. But nonetheless, you cannot ascribe the change in the price of oil or commodities. Let's take a look at some of those. Here, this is the, sorry, got to put it up. The Bloomberg Commodities Index with the dollar. And this is actually showing a better association. From here, dollar index goes down and oil prices go up. So the commodities index goes up. So there is, and my guess why there's that closer displaced in time, but still, and you're talking about oops, I didn't get a good cut on the years here. Oops. Okay, anyway, this is 2000. Now remember, this is about here. So the correlation is pretty good. This is the high, it starts to fall. This is near the low, it starts to rise. So the correlation is pretty good. And it's not really nearly as good in oil. My guess on that difference would be that oil is much more highly speculative than the Bloomberg Commodities Index. That oil is the primary chief speculative vehicle in commodities, and therefore the results are going to be more divorced from fundamentals, and you could make the case that a change in the value of the dollar is a fundamental aspect of any commodity pricing, and I would agree with that. Okay, so that's that. So here's another aspect of this, the same idea. This is oil and Fed funds. Now, as the Fed funds go up, this period right here, and again, the big difference here is the split around, I'd say 2000, but you can make it, doesn't matter when it is. Variation in the Fed funds back here, historically, produced nothing or is correlated with nothing like the type of variation in the oil price that started to take place from here. After all, this rise from here to here under Bernanke is hardly unprecedented in US interest rate policy history. But the rise in oil is utterly unprecedented. Okay. Let's look at another fundamental factor, one which has been continually spoken of as the reason that prices are changing. And guess what this is? China. Here it comes. Okay? China is going to do this. China is going to do that. China is going to use commodities. And you know what? It's true. So this is a chart of Chinese GDP, constant prices year over year in dollars. Or is this dollar yuan? Dollar yuan, okay. And commodities. Now, prior to, say, 1995, look at the difference. And the reason there's that gap is because when you look at China GDP, well, the reason there's a gap back there, if you look at the year-on-year, the quarterly change, this is actually change year over year. But you would get the same effect. I thought about using the chart for an absolute value for the Chinese economy. The reason is there's not that much of an effect back here. After all, if you're looking at an economic growth rate, you're looking at actual use in commodities. But you're also looking at the instigator and the cause of a trend on trading markets. But back here, the difference why there's not much effect is probably the absolute, my guess is it's the absolute value, meaning the absolute size of the Chinese economy back in the early 90s was minuscule compared to what it is now. They really hadn't gotten moving as 25 years ago, after all. And so however much they use, however much the economy grows is a percentage on a very tiny base, so there isn't much use, just an absolute amounts. Once the economy starts going, at one point China was using half of the oil, the iron ore in the world. So there is, to this, a very close connection as a trend in commodity pricing. Okay, that makes sense, as you would expect. Now let's look at this one. This is Chinese imports. So as the marginal consumer who matters the most in the world, it is without question the People's Republic. Now this is a little different. This is Chinese imports. Year over year percentage change, which is in white, against the Chinese, against the Bloomberg Commodities Index in yellow. And you'll see that there is also here, but not nearly as close, but there is here also a pretty substantial correlation between China as the marginal consumer of commodities and prices, as you would expect. Okay, let's look at one more here. Okay, now this, I put this up kind of for fun. This is the Fed funds rate, gold. You know what, let's do this one in a minute because this is a slightly different topic here, okay? So let's take another look. So we have China as the marginal consumer. But what do we see in actual pricing? The change in price, let's look at this one right here, sorry. The change in pricing becomes a factor in trading far beyond its reality. What do I mean by that? As with the DXY and oil prices in the prior 2000 era, the prices, once the change in WTI hit as far as the NYMEX and the ICE exchange in London, the variation, the volatility became much, much greater. And that's exactly what you see in other industrial commodities. Here, let's put up copper, okay? Copper versus DXY, okay? It's copper versus DXY. What has happened, in my view, is that the fact that China is now the marginal consumer of most importance, which is no doubt that that's true, is that instead of what you would have had in a prior era where the usage and the prices rise and fall in a relationship, maybe a strained relationship, but they're still married. They are now divorced. I don't know if this analogy is going to work, but I'm going to try it. Here. Okay, this is DXY and copper. Okay, DXY goes up here. Copper doesn't budge throughout this period right here. Right? There isn't any translation from the change in DXY. This is as you would expect. What's happened now is that the traders are getting their cues and clues from the Chinese economy as to whether China, and this is true of currencies as well, the Australian dollar, the Canadian dollar, the resource currencies. China becomes the indicator of choice for positioning, for trends, for price evolution. But the degree of variation is higher by several factors than it had been in a prior world, before the internet, before 2000, if you will. In other words, if the United States goes into a serious recession, let's see if we can find a WTI price here. Hang on. Here we go. WTI. Okay. Back there in the early 82, 83, 84. U.S. went into serious recession, first term of Ronald Reagan. Fed raised rates to 19%, 12%, whatever it was, to squeeze out inflation. It worked. Okay, we've been in a different world since then. But, so that is a real economic change. The U.S. is going into a serious double-dip recession, which would have its effect in oil usage. But look at the variation in oil price. Minuscule. This is an industrial tied commodity, as I call it. This is a freed industrial commodity. And China is now entering into the pricing of commodities as an indicator factor for trend trading. And I think that is a big change in the way markets both approach and use commodities. Because what we're seeing is a reflection, if oil changes from here to here because of recession in the United States, it's within the realm of historical knowledge and external experience for the oil industry itself. Yeah, people are going to go bankrupt, but it's within the boundaries of experience. The market being tied to the real world usage of oil. What we see here is the divorce. Well, the divorce, as I said earlier, brings on real world changes that didn't really have to happen before. This is, of course, combined with the low interest rates that we've seen. But this makes for a much more volatile world. Because all of this shale oil in the United States and around the world, they didn't drill and pay for that CapEx from a piggy bank. It was paid for by loans and bonds, financial instruments. And those are either impaired or going to go bankrupt unless oil starts changing its price. Well, what's the problem? All that production's waiting to come back online. There's, in my mind, there's probably a cap at least around $60 and probably lower that will prevent oil from going any higher than that because we have all this production in limbo, which can be brought back. So there's a real effect from this change in industrial pricing. Trading markets overshoot. Trading markets are far more volatile than markets that have their speculative participation capped. So the message, I think, of the change in the commodity markets is a real one. there were many, you heard a lot about the commodity super cycle and all this other stuff. Anytime you start hearing super cycle and stuff like that in relation to trading markets, you should probably just take it with a few grains of salt. But in this case, I don't think there was ever actually a super cycle. What there was this basic change in the trading aspects of commodity markets, ones which we'll live with for some time. Now, as far as the future goes, I would say that, as with most markets, hotness wears off and becomes first warm and then lukewarm. And so the hot money, the money that traces this type of speculative trading, will diminish in two fashions. One, I think that as interest rates, and they're going to have to sooner or later rise, then the amount of money chasing outsized returns will reduce and will dissipate. And two, the market is probably not going to repeat the type of speculative excess that it saw. I don't think it's about to be controlled. I just think the participants will look for somewhere else. Okay, folks, that is my disquisition today on the commodity markets. I hope it was interesting, and I hope everyone found it useful. I will put my email address, if I can figure out how to do this, into the email here. And anyone has any comments, criticism, questions, or anything else, please send me an email and I'll be glad to answer it. I do not see how to put this in. Anyway, I don't want to prolong this anymore. I thank you all very much for attending. It's been a pleasure. I enjoy these very much. I hope you do too. And we will do this again next week. I'm going to be giving the topic to FX Street on Monday for the following week, and so they should have it up by Tuesday or Wednesday, and if you're interested, you can check it out. Again, thank you all very much for attending. Have a great day, wherever you are in the world. Thank you very much, Adinda and Mauricio, and we will see you all next week. Thank you.